Welcome back. Today we are presenting the annual profit plan and supporting schedules questions. Next episode, questions C1, cost and variance measure. Please follow the channel and like the video to follow all the questions of the first and second parts of the CMA, new releases. Let's start. Question 1. Peterson's Planters Incorporated budgeted the following amounts for the coming year. Overhead is estimated to be 2 times the amount of direct labor dollars. The amount that should be budgeted for direct labor for the coming year is A. $315,000, B. $105,000, C. $157,500, D. $210,000, B. $105,000 is the correct answer. Since there was no change in work-in-process inventory, cost of goods manufactured equals total manufacturing costs. Cost of goods manufactured is calculated as follows. Cost of goods manufactured equals ending finished goods plus cost of goods sold minus beginning finished goods. Cost of goods manufactured equals $25,000 plus $400,000 minus $10,000 equals $415,000. Since cost of goods manufactured is equal to total manufacturing costs, use the following formula to solve for direct labor costs. Total manufacturing costs equals direct material plus direct labor plus manufacturing overhead. $415,000 equals $100,000 plus direct labor plus 2 direct labor. $415,000 equals $100,000 plus 3 direct labor. $315,000 equals 3 direct labor. Direct labor equals $105,000. Question 2. Data regarding Johnson Incorporated's forecasted dollar sales for the last 7 months of the year and Johnson's projected collection patterns are as follows. Johnson's budgeted cash receipts from sales and collections on account for September are A. $827,000, B. $635,000, C. $684,500, D. $807,000. The answer is C. $684,500. The budgeted cash receipts from sales and collections on account for September are calculated as follows. Budgeted cash receipts from sales and collections on account, September, equals September cash sales, plus collections from September credit sales, plus collections from August sales, plus collections from July sales. September cash sales equals 30%, September sales equals 0.3, $800,000 equals $240,000. Collections from September credit sales equals 20%, 70%, September sales. Collections from September credit sales equals 0.2, 0.7, $800,000 equals $112,000. Collections from August sales equals 50%, 70%, August sales. Collections from August sales equals 0.5, 0.7, $650,000 equals $227,500. Collections from July sales equals 25%, 70%, July sales. Collections from July sales equals 0.25, 0.7, $600,000 equals $105,000. Budgeted cash receipts from sales and collections on account. September equals $240,000 plus $112,000 plus $227,500 plus $105,000 equals $684,500. Question 3. It's January 1st and an accountant is preparing her firm's cash budget. Obtaining the following information. Sales for the previous November and December were $50,000 and $52,000, respectively. Sales projected for January and February are $55,000 and $57,000, respectively. Direct materials, DM, purchases are approximately 40% of sales. Firm policy dictates that all DM are purchased the month prior to their use in production. Historical payment patterns indicate that 30% of DM purchases are paid in the same month as the purchase, 50% are paid the month following the purchase and 20% are paid 2 months following the purchase. What are expected cash disbursements for direct materials in January? A. $22,000. B. $26,160. C. $22,800. D. $23,840. The answer is A. $22,000. DM purchases must first be computed. They are $20,800 in November, $22,000 in December, and $22,800 in January. Next, apply the payment patterns. In January, $6,840 of January DM purchases are paid, $22,800 times 30%. $11,000 of December DM purchases are paid, $22,000 times 50%. $4,160 of November purchases are paid, $20,800 times 20%. Expected cash disbursements for direct materials in January are $6,840 plus $11,000 plus $4,160 equals $22,000. Question 4. What is the standard cost for a unit if the process should consume 8 pounds of direct material at $1.50 per pound? Actual cost was 7.50 pounds at $2 per pound, should use 0.5 direct labor hours at $10 per hour. Actual cost was 0.6 hours at $10 per hour, and uses a factory overhead rate of $20 per direct labor hour. In factory overhead, actual cost was $9.50 per unit. A. $17 per unit. B. $25 per unit. C. $9 per unit. D. $27 per unit. The answer is D. $27 per unit. The standard cost is determined using the should cost amounts, 8 pounds times $1.50, plus 0.5 times $10, plus 0.5 times $20, equals $27 per unit. Question 5. Which one of the following items is the last schedule to be prepared in the normal budget preparation process? A. Selling expense budget. B. Cost of goods sold budget. C. Manufacturing overhead budget. D. Cash budget. The answer is D. Cash budget. The cash budget is the last schedule to be prepared in the normal budget preparation process. All of the other budgets listed are needed in order to determine the receipts and disbursements required to prepare the cash budget. Question 6. The following information relates to Clyde Corporation, which produced and sold 50,000 units during a recent accounting period. In the next accounting period, if production and sales are expected to be 40,000 units, the company should anticipate a per unit contribution margin of A. $3.10, B. 55 cents, C. $7.98, D. $13.30. The answer is D. $13.30. Contribution margin per unit is calculated by taking the unit sales price and subtracting all variable costs. Since the company sold 50,000 units to generate revenue of $850,000, the per unit selling price is $17, $850,000/50,000 equals $17. Per unit variable manufacturing costs are $2.80, $140,000/50,000. Per unit selling and administrative costs are 90 cents, $45,000/50,000. Per unit contribution margin is therefore $13.30, $17 minus $2.80 to 90 cents. Question 7. Myers Company uses a calendar year and prepares a cash budget for each month of the year. Which one of the following items should be considered when developing July's cash budget? A. Recognition that 0.5% of the July sales on account will be uncollectible. B. Quarterly cash dividends scheduled to be declared on July 15 and paid on August 6 to shareholders of record as of July 25. C. Property taxes levied in the last calendar year scheduled to be paid quarterly in the coming year during the last month of each calendar quarter. D. Federal income tax and Social Security tax withheld from employees' June paychecks to be remitted to the Internal Revenue Service in July. The answer is D. Federal income tax and Social Security tax withheld from employees' June paychecks to be remitted to the Internal Revenue Service in July. When preparing a cash budget for the following month, those cash items that are to be received or made payable in the following month should be only those items included in the cash budget. In this problems, the only item that will affect cash in the month of July are those federal income and Social Security taxes withheld from employees' paychecks in June that will be required to be paid in July. Question 8. If a firm's desired ending direct materials (DM) inventory is 20% of the upcoming month's DM usage, then which of the following is likely to be false, assuming no change in DM cost? A. When sales are increasing and decreasing in alternating months, the volatility in the DM purchases budget will be greater than the volatility in the DM usage budget. B. When sales are rising each month, the DM purchases budget will be increasing each month. C. When sales are rising each month, the DM purchases budget will be greater than the DM usage budget. D. The DM purchases budget will be less than the DM usage budget if sales are declining each month. The answer is A. When sales are increasing and decreasing in alternating months, the volatility in the DM purchases budget will be greater than the volatility in the DM usage budget. Recall that budgeted DM purchases equals budgeted DM usage plus desired ending DM inventory minus beginning DM inventory. If sales rise, and then proceed to fall, DM usage rises but desired ending DM inventory falls, so we're adding a smaller number, and then we subtract a larger beginning inventory, because of the higher current month's sales. This pattern will result in less variability in DM purchases compared to DM usage. Question 9. Maximilian Computer Company uses a comprehensive budgeting system in planning its annual operations. Which of the following best describes the information needed in order to determine the budgeted cost of circuit boards to be purchased for use in building its laptop computer? Assume one circuit board is used in each laptop. A. Begin with budgeted laptop production in units, add the desired ending inventory of circuit boards, deduct the expected beginning inventory of circuit boards, and multiply the resulting amount by the purchase cost per circuit board. B. Begin with budgeted laptop sales in units, deduct the desired ending inventory of circuit boards, add the expected beginning inventory of circuit boards, and multiply the resulting amount by the purchase cost per circuit board. C. Begin with budgeted laptop production in units, add the desired ending inventory of circuit boards, add the expected beginning inventory of circuit boards, and multiply the resulting amount by the budgeted purchase cost per circuit board. D. Begin with budgeted laptop sales in units, add the desired ending inventory of circuit boards, deduct the expected beginning inventory of circuit boards, and multiply the resulting amount by the budgeted purchase cost per circuit board. The answer is A. Begin with budgeted laptop production in units, add the desired ending inventory of circuit boards, deduct the expected beginning inventory of circuit boards, and multiply the resulting amount by the purchase cost per circuit board. To determine the budgeted cost of purchases, the number of units to be produced should be adjusted by the change in inventory and then multiplied by the budgeted purchase cost. Question 10. ACE Manufacturing plans to produce two products, Product C and Product F, during the next year, with the following characteristics. Total projected fixed costs for the company are $30,000. Assume that the product mix would be the same at the break-even point as at the expected level of sales of both products. What is the projected number of units, rounded, of Product C to be sold at the break-even point? A. 2,308 units. B. 9,231 units. C. 15,000 units. D. 11,538 units. The answer is B. 9,231 units. The break-even point occurs when the contribution margins of the two products is equal to the fixed costs, which are given as $30,000. The contribution margin of each product is calculated as follows. Contribution margin equals selling price per unit minus variable cost per unit, product volume. Contribution margin, Product C equals $10 minus $8, C equals 2C, where C equals the volume of Product C. Since the expected sales mix of Product C to Product F is 20,000:5,000, or 4:1, the contribution margin for Product F can be calculated as follows. Contribution margin, Product F equals $15 minus $10, 1/4, C equals 1.25 C. The break-even point in units for Product C can then be calculated as follows. Break-even point in units, Product C equals 2C plus 1.25 C equals $30,000. Break-even point in units, Product C equals 3.25 C equals $30,000. Break-even point in units, Product C equals 9,231 units. Question 11. Daffy Toons manufactures an animated rabbit with moving parts and a built-in voice box. Projected sales in units are: each rabbit requires basic materials that Daffy purchases from a single supplier at $3.50 per rabbit. Voice boxes are purchased from another supplier at $1 each. Assembly labor cost is $2 per rabbit and variable overhead cost is 50 cents per rabbit. Fixed manufacturing overhead applicable to rabbit production is $12,000 per month. Daffy's policy is to manufacture 1.5 times the coming month's projected sales every other month starting with January, i.e., odd-numbered months, for February sales, and to manufacture 0.5 times the coming month's projected sales in alternate months, i.e., even-numbered months. This allows Daffy to allocate limited manufacturing resources to other products as needed during the even-numbered months. The dollar production budget for animated rabbits for February is: A. $327,000. B. $113,500. C. $127,500. D. $390,000. The answer is C. $127,500. The budgeted costs for February production are calculated by taking the unit variable costs of production, basic materials, voice box, assembly labor, and variable overhead per rabbit, multiplied by the number of rabbits to be produced, and adding that to the monthly fixed manufacturing overhead costs of $12,000. The variable costs per rabbit are $3.50, basic material, plus $1, voice box, plus $2, direct labor, plus 50 cents, variable overhead, which totals $7 per unit. The number of units budgeted for February, an even-numbered month, are 0.5, 33,000 units, equals 16,500 units. The budgeted costs for February equals $7, 16,500 units, plus $12,000 equals $115,500 plus $12,000 equals $127,500. Question 12. Over the past several years, McFadden Industries has experienced the following regarding the company's shipping expenses. Shown below are McFadden's budget data for the coming year. McFadden's expected shipping costs for the coming year are: A. $20,000. B. $16,000. C. $20,800. D. $4,800. The answer is C. $20,800. Total shipping costs include both fixed and variable shipping costs. Total shipping costs equals fixed shipping cost plus variable shipping cost. Total shipping costs equals $16,000 plus 50 cents, number of pounds shipped. Total shipping costs equals $16,000 plus 50 cents, 9,600 lbs. Total shipping costs equals $16,000 plus $4,800 equals $20,800. Question 13. Swan Company is a maker of men's slacks. The company would like to maintain 20,000 yards of fabric in ending inventory. The beginning fabric inventory is expected to contain 25,000 yards. The expected yards of fabric needed for sales is 90,000. How many yards of fabric does Swan need to purchase? A. 85,000 yards. B. 95,000 yards. C. 90,000 yards. D. 135,000 yards. The answer is A. 85,000 yards. Purchases in yards are calculated as follows. Purchases in yards equals sales in yards, plus ending inventory in yards, minus beginning inventory in yards. Purchases in yards equals 90,000 yards plus 20,000 yards minus 25,000 yards equals 85,000 yards. Question 14. When presenting a production budget aggregated to the quarterly level, which of the following is true? A. Sales are totaled for the 3 months, but ending inventory counts only the last month and beginning inventory counts only the first month. B. Sales, beginning, and ending inventories are not totaled, but the last month's data is used for the quarterly totals. C. Sales are totaled, and beginning and ending inventories are averaged across the quarter. D. Sales, beginning, and ending inventories are totaled for each of the 3 months. The answer is A. Sales are totaled for the 3 months, but ending inventory counts only the last month and beginning inventory counts only the first month. The sales totals are summed for the quarter, but beginning inventory for the quarter is the same as the beginning inventory for the first month, while ending inventory for the quarter is the ending inventory for the last month of the quarter. Question 15. The Mountain Mule Glove Company is in its first year of business. Mountain Mule had a beginning cash balance of $85,000 for the quarter. The company has a $50,000 short-term line of credit. The budgeted information for the first quarter is shown below. All sales are made on credit and are collected in the second month following the sale. Purchases are paid in the month following the purchase, while operating costs are paid in the month that they are incurred. How much will Mountain Mule need to borrow at the end of the quarter if the company needs to maintain a minimum cash balance of $5,000 as required by a loan covenant agreement? A. $0. B. $5,000. C. $45,000. D. $10,000. The answer is D. $10,000. The projected cash balance, without borrowing, at the end of the quarter is calculated as follows. Projected cash balance, without borrowing, end of quarter equals, beginning cash balance, plus, projected cash receipts, minus, projected cash disbursements. Beginning cash balance for the quarter equals $85,000. Projected cash receipts for the quarter are equal to the January sales amount, because all sales are made on credit and are collected in the second month following business. Projected cash receipts for the quarter equals $60,000. Projected cash disbursements for the quarter will include the purchases from January and February. March purchases are not included, because they will be paid for in April, plus the operating costs for the months of January, February, and March. Projected cash disbursements equals $35,000 plus $40,000 plus $25,000 plus $25,000 plus $25,000 equals $150,000. The projected cash balance, without borrowing, for the end of the quarter, can be calculated as follows. Projected cash balance, without borrowing, end of quarter equals $85,000 plus $60,000 minus $150,000 equals minus $5,000. Therefore, $10,000 will have to be borrowed to maintain a minimum cash balance of $5,000. Question 16. Assume it is January 1st. A firm had sales of $30,000 and $32,000 in the previous November and December, respectively. Projected sales for January are $38,000. Past collection patterns indicate that 50% of sales are cash sales. 10% of credit sales are typically collected in the same month as the sale, 80% are collected the month following the sale, and 10% are collected 2 months after the month of the sale. How much money is expected to be collected in January? A. $35,200. B. $20,900. C. $51,400. D. $49,500. The answer is A. $35,200. In January, cash sales are $19,000, $38,000 times 50%. Credit sales collected from January would be $1,900, $38,000 times 50% times 10%. Credit sales collected from December would be $12,800, $32,000 times 50% times 80%. Credit sales collected from November would be $1,500, $30,000 times 50% times 10%. The sum of cash collected is $19,000 plus $1,900 plus $12,800 plus $1,500 equals $35,200. Question 17. Tidwell Corporation sells a single product for $20 per unit. All sales are on account, with 60% collected in the month of sale and 40% collected in the following month. A partial schedule of cash collections for January through March of the coming year reveals the following receipts for the period. Other information includes the following. Inventories are maintained at 30% of the following month's sales. In units, assume that March sales total $150,000. The number of units to be purchased in February is A. 7,750 units. B. 4,900 units. C. 6,100 units. D. 3,850 units. The answer is C. 6,100 units. The expected unit purchases for any month is calculated as follows. Expected purchases equals expected sales in units, plus expected ending inventory, minus expected beginning inventory, the expected ending inventory for a month is 30% of the next month's expected sales. Expected sales is calculated as follows. Expected sales equals sales in $$, selling price per unit, number of units to be purchased in February equals $110,000/$20 per unit, plus 0.3, $150,000/$20 per unit, minus 0.3, $110,000/$20 per unit. Number of units to be purchased in February equals 5,500 units plus 0.3, 7,500 units, minus 0.3, 5,500 units. Number of units to be purchased in February equals 5,500 units plus 2,250 units minus 1,650 units equals 6,100 units. Question 18. All of the following are part of a capital investment budget except A. Factory machine purchase price. B. Cost of disposing of the old machine being replaced. C. Installation of the factory machine. D. Research and development costs. The answer is D. Research and development costs. Research and development costs are period costs that must be expensed in the period incurred and are therefore not part of a capital budget. Question 19. Jordan Auto has developed the following production plan. Each unit contains 3 pounds of raw material. The desired raw material ending inventory each month is 120% of the next month's production, plus 500 pounds. The beginning inventory meets this requirement. Jordan has developed the following direct labor standards for production of these units. How much raw material should Jordan Auto purchase in March? A. 43,700 pounds. B. 32,900 pounds. C. 37,800 pounds. D. 27,000 pounds. The answer is C. 37,800 pounds. The monthly raw material purchase requirement must be sufficient to cover the necessary monthly production requirement, plus the required monthly ending inventory, less the month's beginning inventory. Monthly raw material purchase amount equals current month production requirement plus current month's ending inventory minus current month's beginning inventory. Monthly raw material purchase amount equals current month production requirement in units, amount of raw material required per unit, plus next month's production, 1.2, plus 500 pounds, plus current month raw materials beginning inventory. Note, the current month's raw materials beginning inventory is calculated by taking the current month's production and multiplying it by 1.2. The production requirement is 3 pounds of raw material per unit of output. The desired ending inventory for each month is 120% of, or 1.2 times the next month's production requirement, which works out to 3.6 pounds, 1.2 times 3 pounds, per unit multiplied by the next month's production in units, plus 500 pounds. Keep in mind that the ending inventory for 1 month will become the beginning inventory for the next month. March raw materials requirement equals March production units times pounds used. Per unit equals 9,000 units times 3 pounds per unit equals 27,000 pounds. March raw materials ending inventory equals 1.2, 3 pounds, 12,000 April units. Plus 500 pounds equals 43,200 plus 500 is equal to 43,700 pounds. March raw materials beginning inventory, which is the same as the February raw materials ending inventory, equals 1.2, 3 pounds, 9,000 March units, plus 500 pounds equals 32,400 plus 500 is equal to 32,900 pounds. Therefore, the March raw material purchase requirement equals 27,000 pounds plus 43,700 pounds minus 32,900 pounds equals 37,800 pounds. Question 20. ANNCO sells products on account and experiences the following collection schedule. At December 31st, ANNCO reports accounts receivable of $211,500. Of that amount, $162,000 is due from December sales, and $49,500 from November sales. ANNCO is budgeting $170,000 of sales for January. If so, what amount of cash should be collected in January? A. $129,050. B. $174,500. C. $211,500. D. $228,500. The answer is B. $174,500. The amount of cash that should be collected in January is calculated as follows. Cash collections, January equals accounts receivable collected from November sales, plus accounts receivable collected from December sales, plus accounts receivable collected from January sales, accounts receivable collected during January from December sales equals 60%, December sales, accounts receivable collected during January from December sales equals 60%, $180,000 equals $108,000 where December sales is calculated as follows. At the end of December, $162,000 is due from December sales. Since 10% was collected during December, $162,000 must be 90% of December sales, 90%. December sales equals $162,000, 0.9, December sales equals $162,000, December sales equals $162,000 slash 0.9 equals $180,000. Accounts receivable collected during January from January sales equals 10%, January sales, accounts receivable collected during January from January sales sad face 10%, $170,000 equals $17,000. Cash collections, January equals $49,500 plus $162,000 plus $17,000. Cash collections, January equals $49,500 plus $108,000 plus $17,000 equals $174,500. Question 21. Brown Company estimates that monthly sales will be as follows. Historical trends indicate that 40% of sales are collected during the month of sale, 50% are collected in the month following the sale, and 10% are collected 2 months after the sale. Brown's accounts receivable balance as of December 31 totals $80,000, $72,000 from December's sales and $8,000 from November's sales. The amount of cash Brown can expect to collect during the month of January is A. $76,800, B. $84,000, C. $133,000, D. $108,000. The answer is D. $108,000. The expected cash receipts for January can be calculated as follows. Expected cash receipts for January equals 40% of January sales plus 50% of December sales plus 10% of November sales. Calculate December sales as follows. Since 40% of December sales were collected in December, the remaining amount for December in accounts receivable must equal 60% of December sales. Use the following formula to determine December sales. 60% December sales equals $72,000, 0.6 December sales equals $72,000, December sales equals $72,000 / 0.6 equals $120,000. The entire $8,000 remaining in accounts receivable for November will be collected in January. No calculations are necessary. Expected cash receipts for January equals 40%, $100,000, plus 50%, $120,000, plus $8,000. Expected cash receipts for January equals 0.4, $100,000, plus 0.5, $120,000, plus $8,000. Expected cash receipts for January equals $40,000 plus $60,000 plus $8,000 equals $108,000. Question 22. The direct materials budget is often broken down into A. A direct materials mix budget and a direct materials yield budget. B. A direct materials usage budget and a direct materials purchase budget. C. A direct materials mix budget and a direct materials purchase budget. D. A direct materials yield budget and a direct materials usage budget. The answer is B. A direct materials usage budget and a direct materials purchase budget. The direct usage budget plus the direct materials purchase budget equals the direct materials budget. Question 23. Projected monthly sales of Wallstead Corporation for January, February, March, and April are as follows. The company bills each month's sales on the last day of the month. Receivables are booked gross and credit terms of sale are 2/10 N/30. 50% of the billings are collected within the discount period, 30% are collected by the end of the month, 15% are collected by the end of the second month, and 5% become uncollectible. Budgeted cash collections for Wallstead Company during April would be A. $347,000, B. $343,300, C. $353,000, D. $349,300. The answer is B. $343,300. In this problem, the budgeted cash collections in any month can be calculated as follows. Budgeted cash collections equals 50%, 98% of the sales from the previous month, collected within the discount period, plus 30% of the sales from the previous month, no discount taken, plus 15% of the sales from the month before that. For April, the budgeted cash collections equals 50%, 98% of March sales, plus 30% of sales from March, plus 15% of sales from February. Budgeted cash collections, April equals 0.5, 0.98, $370,000, plus 0.3, $370,000, plus 0.15, $340,000. Budgeted cash collections, April equals $181,300 plus $111,000 plus $51,000 equals $343,300. Question 24. A cost of goods sold, COGS, budget for a manufacturing firm contains which of the following primary components? A. Cost of goods manufactured, COGM, and finished goods inventory balances. B. Cost of goods manufactured, COGM, and direct materials inventory balances. C. Budgeted direct materials purchases, budgeted direct labor, and budgeted factory overhead. D. Budgeted direct materials used and budgeted direct labor. The answer is A. Cost of goods manufactured, COGM, and finished goods inventory balances. COGS for a manufacturing firm is defined as beginning finished goods inventory plus COGM less ending finished goods inventory. The COGM may be expanded in this report, where COGM is defined as budgeted direct materials used, not purchased, budgeted direct labor, and budgeted factory overhead. Question 25. Given the following data for Scurry Company, what is the cost of goods? A. $950,000. B. $800,000. C. $500,000. D. $600,000. The answer is D. $600,000. Cost of goods sold is calculated as follows. Cost of goods sold equals cost of goods manufactured plus beginning finished goods inventory minus ending finished goods inventory. Cost of goods sold equals $700,000 plus $100,000 minus $200,000. Cost of goods sold equals $600,000. Question 26. Streeter Company produces plastic microwave turntables. Sales for the next year are expected to be 65,000 units in the first quarter, 72,000 units in the second quarter, 84,000 units in the third quarter, and 66,000 units in the fourth quarter. Streeter usually maintains a finished goods inventory at the end of each quarter equal to 1/2 of the units expected to be sold in the next quarter. However, due to a work stoppage, the finished goods inventory at the end of the first quarter is 8,000 units less than it should be. How many units should Streeter produce in the second quarter? A. 86,000 units. B. 78,000 units. C. 75,000 units. D. 80,000 units. The answer is A. 86,000 units. Budgeted production is calculated as follows. Budgeted production equals expected sales plus expected ending inventory minus expected beginning inventory. The expected ending inventory for each quarter equals 50% of the next quarter's expected sales. Since the finished goods inventory at the end of the first quarter is 8,000 less than it should be, the budgeted production for the second quarter is calculated as follows. Budgeted production, second quarter equals 72,000 units plus 0.5, 84,000 units, minus 0.5, 72,000 units, minus 8,000 units. Budgeted production, second quarter equals 72,000 units plus 42,000 units minus 36,000 units minus 8,000 units. Budgeted production, second quarter equals 114,000 units minus 28,000 units equals 86,000 units. Question 27. 1B5CQ05. Streeter Company produces plastic microwave turntables. Sales for the next year are expected to be 65,000 units in the first quarter, 72,000 units. In the second quarter, 84,000 units in the third quarter and 66,000 units in the fourth quarter. Streeter maintains a finished goods inventory at the end of each quarter equal to 1/2 of the units expected to be sold in the next quarter. How many units should Streeter produce in the second quarter? A. 75,000 units. B. 84,000 units. C. 78,000 units. D. 72,000 units. The answer is C. 78,000 units. The expected production in each quarter is calculated as follows. Expected production equals expected sales plus expected ending inventory minus expected beginning inventory. The expected ending inventory for each quarter is 50% of the following quarter's sales. Therefore, the expected production for the second quarter is calculated as follows. Expected production, second quarter equals 72,000 plus 0.5, 84,000, minus 0.5, 72,000. Expected production, second quarter equals 72,000 plus 42,000 minus 36,000 is equal to 78,000 units. Question 28. Cooper Company's management team is preparing a cash budget for the coming quarter. The following budgeted information is under review. The company expects to collect 40% of its monthly sales in the month of sale and 60% in the following month. 50% of inventory purchases are paid in the month of purchase, and the other 50% in the following month. All payments for other expenses are made in the month incurred. Cooper forecasts the following account balances at the beginning of the quarter. Cash 100,000. Accounts receivable 300,000. Accounts payable, inventory, 500,000. Given the above information, the projected change in cash during the coming quarter will be A. -$0. B. $300,000. C. $412,500. D. $112,500. The answer is D. $112,500. The projected change in cash for the upcoming quarter is equal to the projected cash receipts for the quarter, less the projected cash disbursements for the quarter. Projected change in cash equals projected cash receipts minus projected cash disbursements. The projected cash receipts for the quarter is calculated as follows. Projected cash receipts for the quarter equals accounts receivable, beginning of quarter, plus January and February sales, plus 40% of March sales. Projected cash receipts for the quarter equals $300,000, plus $700,000, plus $800,000, plus $0.4, $500,000. Projected cash receipts for the quarter equals $1,800,000 plus $200,000 equals $2 million. The projected cash disbursements is equal to the accounts payable at the beginning of the quarter, plus the other cash expenses for January, February, and March, plus January and February purchases, plus 50% of March purchases. Projected cash disbursements equals $500,000 plus $150,000 plus $175,000 plus $175,000 plus $350,000 plus $425,000 plus $0.5, $225,000. Projected cash disbursements equals $1,775,000 plus $112,500 equals $1,887,500. Projected change in cash equals $2 million minus $1,887,500 equals $112,500. Question 29. Stevens Company manufactures electronic components used in automobile manufacturing. Each component uses two raw materials, Geo and Clio. Standard usage of the two materials required to produce one finished electronic component, as well as the current inventory, are shown below. Stevens forecasts sales of 20,000 components for the next two production periods. Company policy dictates that 25% of the raw materials needed to produce the next period's projected sales be maintained in ending direct materials inventory. Based on this information, what would the budgeted direct material purchases for the coming period be? A. GO equals $675,000, Clio equals $400,000. B. GO equals $450,000, Clio equals $450,000. C. GO equals $825,000, Clio equals $450,000. D. GO equals $675,000, Clio equals $300,000. The answer is D. GO equals $675,000, Clio equals $300,000. The expected material purchases in units for any month can be calculated as follows. Expected material purchases equals production needs for the month, plus expected ending inventory, minus expected beginning inventory. The expected ending inventory for any month is 25% of the next month's expected sales. Since 2 pounds of GO are used per unit, the expected purchase of GO can be calculated as follows. Expected purchases of GO equals 2 pounds, 20,000, plus 0.25, 2 pounds, 20,000, minus 5,000 pounds. Expected purchases of GO equals 40,000 pounds plus 10,000 pounds minus 5,000 pounds equals 45,000 pounds. Total cost of GO equals 45,000 pounds, $15 per pound, equals $675,000. Since 1.5 pounds of Clio are used per unit, the expected purchase of Clio can be calculated as follows. Expected purchase of Clio equals 1.5 pounds, 20,000, plus 0.25, 1.5 pounds, 20,000, minus 7,500 pounds. Expected purchase of Clio equals 30,000 pounds plus 7,500 pounds minus 7,500 pounds equals 30,000 pounds. Total cost of Clio equals 30,000 pounds, $10 per pound, equals $300,000. Question 30. 1B5CQ35. Tidwell Corporation sells a single product for $20 per unit. All sales are on account, with 60% collected in the month of sale and 40% collected in the following month. A schedule of cash collections for January through March of the coming year reveals the following receipts for the period. Other information includes 1. Inventories are maintained at 30% of the following month's sales. 2. Tidwell desires to keep a minimum cash balance of $15,000. Total payments in January are expected to be $106,500, which excludes $12,000 of depreciation expense. Any required borrowings are in multiples of $1,000. 3. The December 31st balance sheet for the preceding year revealed a cash balance of $24,900. Ignoring income taxes, the financing needed in January to maintain the firm's minimum cash balance is A. $8,000. B. $10,600. C. $23,000. D. $11,000. The answer is D. $11,000. The expected cash balance at the end of January, without financing, is calculated as follows. Expected cash balance, end of January, without financing equals, beginning cash balance, plus, expected cash receipts, minus, expected cash disbursements. Note that the cash balance on January 1st is the same as the ending cash balance on December 31st of the previous year, which is given as $24,900 in this problem. Expected cash receipts during January are calculated by adding together the receivables amounts from December and January that are expected to be collected during January. Expected cash receipts during January equals $32,000 plus $54,000 equals $86,000. Expected cash disbursements during January is given at $106,500. Expected cash balance, end of January, without financing equals $24,900 plus $86,000 minus $106,500. Expected cash balance, end of January, without financing equals $4,400. Therefore, in order to maintain a minimum balance of $15,000, Tidwell Corporation would have to borrow $11,000. Question 31. Which of the following correctly describes the materials purchase budget calculation? A. Sales forecast, in units, times direct materials per unit times direct materials cost, plus desired ending direct materials inventory minus beginning direct materials inventory. B. Sales forecast, in units, times direct materials per unit times direct materials cost, plus beginning direct materials inventory minus desired ending direct materials inventory. C. Number of units to be produced times direct materials per unit times direct materials cost, plus beginning direct materials inventory minus desired ending direct materials inventory. D. Number of units to be produced times direct materials per unit times direct materials cost, plus desired ending direct materials inventory minus beginning direct materials inventory. The answer is D. Number of units to be produced times direct materials per unit times direct materials cost, plus desired ending direct materials inventory minus beginning direct materials inventory. The direct materials usage budget specifies the direct materials needed to meet production demands. Therefore, one must begin with the number of units to be produced, not the number of units forecast in sales. Since beginning inventory is already on hand, it is subtracted while desired ending inventory must be met with production needs. Question 32. Which of the following is not a reason for creating a cash budget? A. To identify periods of excessive cash and begin investigating possible investments for those funds. B. To ensure that liquidity is maintained. C. To sum up all of the other budgets. D. To identify periods of cash shortages and begin finding sources of funds. The answer is C. To sum up all of the other budgets. A cash budget is a plan to ensure that liquidity is maintained. While creating the cash budget, the firm will identify periods of excess and shortage of funds and can plan accordingly. The cash budget does not sum up the other budgets, the master budget does this. Question 33. Consider the following information for Timbuktu Kalamazoo Industries. Additional information. 60% of a month's sales are collected by the month's end, the remaining 40% is collected in the following month. 40% of a month's purchases are paid by the month's end, the remaining 60% is paid in the following month. The desired ending finished goods inventory every month is 30% of the next month's sales. The desired ending direct materials inventory every month is 25% of the next month's production needs. What is the total budgeted production in units for the month of November? A. 1,096. B. 1,564. C. 1,438. D. 1,596. The answer is C. 1,438. To solve this problem, a production budget must be created, which is as follows. Question 34. Which of the following is not an important step in forming a sales budget? A. Creating a projected income statement. B. Analyzing long and short-term company objectives. C. Studying economic forecasts. D. Analyzing production capacity. The answer is A. Creating a projected income statement. The direct labor, direct materials, and overhead budgets required to create a projected or pro forma income statement are made after the sales budget is formed. Question 35. Maker Distributors has a policy of maintaining inventory at 15% of the next month's forecasted sales. The cost of Maker's merchandise averages 60% of the selling price. The inventory balance as of May 31st is $63,000, and the forecasted dollar sales for the last 7 months of the year are as follows. What is the budgeted dollar amount of Maker's purchases during July? A. $360,000. B. $355,500. C. $399,000. D. $364,500. The answer is D. $364,500. Purchases in dollars is calculated as follows. Purchases in dollars equals cost of sales plus expected ending inventory minus expected beginning inventory. Cost of sales equals 100% minus the gross profit percentage, sales. Cost of sales equals 100% to 40%, sales in dollars. The expected ending inventory for each month equals 15% of the next month's expected sales. Therefore, the purchases in dollars for July can be calculated as follows. Purchases for July equals 0.6, $600,000, plus 0.15, 0.6, $650,000, minus 0.15, 0.6, $600,000, purchases for July equals $360,000 plus $58,500 minus $54,000 equals $364,500. Question 36. Using the information from Exhibit A, what is budgeted direct labor cost for February? A. $384,000. B. $383,500. C. $383,250. D. $382,500. The answer is A. $384,000. The number of units to be produced in February, budgeted production equals budgeted sales plus ending inventory, beginning inventory, equals 5,100 units plus 530 units, 10% of 5,300, minus 510 units, 10% of 5,100, equals 5,120 units. Each unit requires $75 of direct labor. 5,120 units times $75 per unit equals $384,000. Question 37. Consider the following information for Timbuktu Kalamazoo Industries. 60% of a month's sales are collected by the month's end and 40% of a month's sales are collected in the following month. What is the total amount of revenue collected from customers in the month of November? A. $29,302. B. $38,962. C. $17,581. D. $27,241. The answer is D. $27,241. The correct answer is $27,241 and is calculated as. Question 38. Which one of the following best describes tactical profit plans? A. Broad, long-term, broad responsibilities, qualitative. B. Detailed, short-term, broad responsibilities, qualitative. C. Broad, short-term, responsibilities at all levels, quantitative. D. Detailed, short-term, responsibilities at all levels, quantitative. The answer is D. Detailed, short-term, responsibilities at all levels, quantitative. Tactical profit plans or budgets should have the following characteristics: detailed, short-term, assigned responsibilities at all levels, and quantified. Question 39. A firm has projected sales of 20,000 and 22,000 units for the next two periods 1 and 2, respectively. The firm maintains an ending finished goods inventory equal to 15% of the next period's projected sales. Each unit requires 2 hours of direct labor at a cost of $15 per hour. Assuming that all inventory standards are currently met, what is the direct labor budget for period 1? A. $690,000. B. $600,000. C. $609,000. D. $699,000. The answer is C. $609,000. Compute the number of units that must be produced in period 1. Budgeted production equals budgeted sales plus ending inventory minus beginning inventory 20,000 plus desired ending inventory of 3,300, 22,000 times 15%, minus beginning inventory of 3,000, 20,000 times 15%, equals 20,300. Each unit takes 2 hours at a cost of $15 per hour. 20,300 times 2 hours times $15 equals $609,000. Question 40. Using the following budget data for Valley Corporation, which produces only one product, calculate the company's predetermined factory overhead application rate for variable overhead. A. $2.30. B. $4.73. C. $2.09. D. $5.20. The answer is C. $2.09. The variable overhead rate per unit is calculated by taking the expected variable overhead and dividing it by the expected production in units. The expected variable overhead consists of indirect materials, indirect labor, and utilities, and is calculated as follows. Variable overhead equals $1,000 plus $10,000 plus $12,000. Variable overhead equals $23,000. Since expected production is 11,000 units, the variable overhead rate equals $23,000/11,000 units equals $2.09 per unit. Question 41. KA Company has been accumulating operating data in order to prepare an annual profit plan. Details regarding KA's sales for the first 6 months of the coming year are: KA's cost of goods sold averages 40% of the sales value. KA's objective is to maintain a target inventory equal to 30% of the next month's sales. Purchases of merchandise for resale are paid for in the month following the sale. The variable operating expenses, other than cost of goods sold, for KA are 10% of sales and are paid for in the month following the sale. The annual fixed operating expenses are presented below. All of these are incurred uniformly throughout the year and paid monthly except for insurance and property taxes. Insurance is paid quarterly in January, April, July, and October. Property taxes are paid twice a year in April and October. The purchases of merchandise that KA Company will need to make during February will be: A. $275,000, B. $266,000, C. $254,000, D. $344,000. The answer is B. $266,000. The monthly purchase requirement must be sufficient to cover the cost of goods sold requirement for the month, plus the required ending inventory for the month, less the beginning inventory for the month. The cost of goods sold requirement is 40% of the month's sales. The ending inventory is supposed to be set at 30% of the following month's sales. The budgeted purchases for February equals cost of goods sold for February plus February ending inventory. February beginning inventory cost of goods sold for February equals 0.4, February sales, February projected ending inventory equals 0.3, 0.4, March sales. February beginning inventory, same as January's projected ending inventory, equals 0.3, 0.4, February sales. The budgeted purchases for February equals 0.40, $650,000, plus 0.3, 0.4, $700,000, minus 0.3, 0.4, $650,000, equals $260,000 plus $84,000 minus $78,000 equals $266,000. Question 42. M Gift Shop maintains a 35% gross profit percentage on sales, and carries an ending inventory balance each month sufficient to support 30% of the next month's expected sales. Anticipated sales for the fourth quarter are as follows: October 42,000, November 58,000, December 74,000. What is the cost of the goods that M Gift Shop should plan to purchase for the month of November? A. $62,800, B. $40,820, C. $52,130, D. $51,220. The answer is B. $40,820. Purchases in dollars is calculated as follows. Purchases in dollars equals cost of sales plus expected ending inventory minus expected beginning inventory. Cost of sales equals 100% minus the gross profit percentage. Sales, cost of sales, November equals 100% to 35%, $58,000 equals 0.65, $58,000 equals $37,700. The ending inventory for each month equals 30% of the next month's expected. Cost of sales ending inventory, November equals 30%, cost of sales, December, sad face 0.3, 0.65, $74,000 equals $14,430. Beginning inventory, November equals 30%, cost of sales, November, sad face 0.3, $37,700 equals $11,310. Therefore, the purchases in dollars for November can be calculated as follows. Purchases for November equals $37,700 plus $14,430 minus $11,310 equals $40,820. Question 43. Using the information from Exhibit A, what is budgeted cost of goods manufactured for the 3-month period of January, February, and March? A. $2,183,100. B. $2,208,750. C. $2,194,500. D. $2,184,525. The answer is B. $2,208,750. The number of units to be sold in this 3-month period is 15,400 units, calculated as the sum of the sales for the period, 5,000 units plus 5,100 units plus 5,300 units. To determine the number of units to be produced, adjust the number of units to be sold, 15,400, by adding desired ending finished goods inventory for March of 600, 6,000 units times 10%, and subtracting beginning finished goods inventory for January of 500, 5,000 units times 10%, leaving 15,500 units to be produced in the 3-month period. Budgeted cost of goods manufactured is 15,500 times $142.50 equals $2,208,750. Question 44. Brooke Company's management team is preparing a cash budget for the coming quarter. The following budgeted information is under review. The company expects to collect 40% of its monthly sales in the month of sale and 60% in the following month. 50% of inventory purchases are paid in the month of purchase, and 50% in the following month. Payments for all other expenses are made in the month incurred. Brooke forecasts the following account balances at the beginning of the quarter. Given the above information, the projected ending cash balance for February will be A. $712,500, B. $500,000, C. $120,000, D. $232,500. The answer is D. $232,500. The projected ending cash balance for February is calculated as follows. Projected ending cash balance, February equals beginning cash balance for the quarter, plus beginning accounts receivable balance for the quarter, plus January sales, plus 40%, February sales, minus January other expenses, minus February other expenses, minus accounts payable balance, beginning of quarter, minus January purchases, minus 50%. February purchases, projected ending cash balance, February equals $200,000, plus $300,000, plus $700,000, plus $0.4, $800,000, minus $150,000, minus $175,000, minus $400,000, minus $350,000, minus $0.5, $425,000. Projected ending cash balance, February equals $232,500. Question 45. The pro forma statement of employee benefit costs, a budget schedule that is prepared as part of an organization's annual profit plan, would include costs related to A. Company-paid benefits and company-paid payroll taxes. B. Employees' gross wages and salaries and the related company-paid benefits. C. All payroll-related deductions withheld from employees and company-paid benefits. D. Employees' net wages and salaries and the related company-paid benefits. The answer is A. Company-paid benefits and company-paid payroll taxes. Using a pro forma statement of employee benefit costs allows a company to view the cost associated with company-paid benefits and company-paid payroll taxes. Question 46. A firm has projected sales of 50,000, 51,000, and 52,000 units for the next 3 periods, periods 1, 2, and 3, respectively. The firm maintains an ending finished goods inventory equal to 10% of the next period's projected sales. Each unit requires 5 pounds of direct material, DM. The firm maintains an ending DM's inventory equal to 15% of the next period's DM's needs. Assume that all inventory standards are currently met. How many pounds of material must be purchased in period 1? A. 251,250 pounds. B. 250,500 pounds. C. 250,750 pounds. D. 250,000 pounds. The answer is A. 251,250 pounds. Compute the number of units that must be produced in periods 1 and 2. Budgeted production equals budgeted sales plus ending inventory minus beginning inventory. Period 1 is equal to 50,000 plus 51,000 times 0.1 minus 50,000 times 0.1 equals 50,100 units. Period 2 is equal to 51,000 plus 52,000 times 0.1 minus 51,000 times 0.1 equals 51,100 units. Then find DMs needed for both periods, multiply number of units to be produced by 5 lbs, getting period 1 DM needs of 250,500 lbs and period 2 DM needs of 255,500 lbs. To find DM purchases for period 1, take period 1 DM needed plus desired ending DM inventory of 38,325 pounds, 255,500 lbs times 15%, less beginning DM inventory of 37,575, 250,500 times 15%, and get 251,250 pounds. Question 47. KA Company has been accumulating operating data in order to prepare an annual profit plan. Details regarding KA's sales for the first 6 months of the coming year are: KA's cost of goods sold averages 40% of the sales value. KA's objective is to maintain a target inventory equal to 30% of the next month's sales. Purchases of merchandise for resale are paid for in the month following the sale. The variable operating expenses, other than cost of goods sold, for KA are 10% of sales and are paid for in the month following the sale. The annual fixed operating expenses are presented below. All of these are incurred uniformly throughout the year and paid monthly except for insurance and property taxes. Insurance is paid quarterly in January, April, July, and October. Property taxes are paid twice a year in April and October. The amount for cost of goods sold that will appear on KA Company's pro forma income statement for the month of February will be A. $240,000, B. $260,000, C. $280,000, D. $266,000. The answer is B. $260,000. Cost of goods sold are 40% of sales, therefore, cost of goods sold for February would be projected to be $0.4, $650,000 equals $260,000. Question 48. A firm has budgeted sales for the next 2 periods of 50,000 units and 55,000 units, respectively. The firm maintains a policy that the beginning of period inventory is 20% of the following period's forecasted sales. The policy is currently met. What is the budgeted production for period 1? A. 49,000 units. B. 50,000 units. C. 61,000 units. D. 51,000 units. The answer is D. 51,000 units. The budgeted production is calculated by adding budgeted sales, 50,000, to desired ending inventory, 55,000 times 0.2 minus the beginning inventory. 50,000 times 0.2 equals 51,000 units. Question 49. Data regarding ROM Bus Company's budget are shown below. ROM Bus Company's production budget will show total units to be produced of A. 3,700 units, B. 4,300 units, C. 4,000 units, D. 4,600 units. The answer is A. 3,700 units. Budgeted production is calculated as follows. Budgeted production equals expected sales plus expected ending inventory minus expected beginning inventory. Budgeted production equals 4,000 units plus 600 units minus 900 units equals 3,700 units. Question 50. Tut Company's selling and administrative costs for the month of August, when it sold 20,000 units, were as follows. The variable costs represent sales commissions paid at the rate of 6.2% off sales. The step costs depend on the number of salespersons employed by the company. In August there were 17 persons on the sales force. However, 2 members have taken early retirement effective August 31st. It is anticipated that these positions will remain vacant for several months. Total fixed costs are unchanged within a relevant range of 15,000 to 30,000 units per month. Tut is planning a sales price cut of 10%, which it expects will increase sales volume to 24,000 units per month. If Tut implements the sales price reduction, the total budgeted selling and administrative costs for the month of September would be A. $759,600, B. $714,960, C. $679,760, D. $652,760. The answer is D. $652,760. Total budgeted selling and administrative costs in this problem can be calculated as follows. Total budgeted selling and administrative costs equals variable costs plus step costs plus fixed costs. Total budgeted selling and administrative costs equals $401,760 plus $75,000 plus $176,000. Total budgeted selling and administrative costs equals $652,760. Rearrange the following formula to determine sales for August, then sales price per unit. Variable costs equals 6.2%, sales. Sales equals variable costs / 0.062 equals $372,000 / 0.062 equals $6 million. Sales price per unit equals sales / units sold equals $6 million / 20,000 equals $300. Expected sales in September equals 90%, August sales price per unit, September sales volume equals 0.9, $300, 24,000 equals $6,480,000. Budgeted variable costs equals 0.062, $6,480,000 equals $401,760. Step costs per salesperson equals $85,000 / 17 salespeople equals $5,000. Due to the retirement of 2 salespeople, the budgeted step costs are reduced and are calculated as follows. Budgeted step costs equals 15 salespeople, $5,000 cost per salesperson equals $75,000. Total budgeted selling and administrative costs equals $401,760 plus $75,000 plus $176,000. Total budgeted selling and administrative costs equals $652,760. Question 51. A company that manufactures furniture is establishing its budget for the upcoming year. All of the following items would appear in its overhead budget except for the source, retired CMA exam questions. A. Overtime paid to the workers who perform production scheduling. B. Fringe benefits paid to the production supervisor. C. Freight charges paid for the delivery of raw materials to the company. D. Cost of glue used to secure the attachment of the legs to the tables. The answer is C. Freight charges paid for the delivery of raw materials to the company. The overhead budget includes those items that cannot be directly traced back to the product itself. Therefore, items such as overtime paid to the workers who perform production scheduling, cost of glue used to secure the attachment of the legs to the tables, and fringe benefits paid to the production supervisor are all inclusive overhead costs. Question 52. Savior Corporation assembles backup tape drive systems for home microcomputers. For the first quarter, the budget for sales is 67,500 units. Savior will finish the fourth quarter of last year with an inventory of 3,500 units, of which 200 are obsolete. The target ending inventory is 10 days of sales, based upon 90 days in a quarter. What is the budgeted production for the first quarter? A. 71,500 units. B. 71,700 units. C. 64,350 units. D. 75,000 units. The answer is B. 71,700 units. The expected beginning inventory is calculated as follows. Expected beginning inventory equals 3,500 units minus 200 obsolete units equals 300 units. The expected ending inventory is 10 days sales, which is calculated as follows. Expected ending inventory equals 67,500 units / 90, 10 equals 7,500 units. Therefore, budgeted production equals 67,500 units plus 7,500 units minus 3,300 units equals 71,700 units. Question 53. Granite Company sells products exclusively on account and has experienced the following collection pattern: 60% in the month of sale, 25% in the month after sale, and 15% in the second month after sale. Uncollectible accounts are negligible. Customers who pay in the month of sale are given a 2% discount. If sales are $220,000 in January, $200,000 in February, $280,000 in March, and $260,000 in April, Granite's accounts. Receivable balance on May 1st will be A. $146,000. B. $143,920. C. $107,120. D. $204,000. The answer is A. $146,000. Given the expected sales collection pattern, the expected accounts receivable at the end of a month would be calculated as follows. Accounts receivable at month end equals 40% of current month's sales uncollected portion plus 15% of prior month's sales. Please note that the beginning balance for May 1st, is the same as the ending balance for April 30th. The May 1st or April 30th accounts receivable balance is then calculated as follows. May 1st accounts receivable balance equals 0.4, $260,000, plus 0.15, $280,000. May 1st accounts receivable balance equals $104,000 plus $42,000 equals $146,000. Question 54. Daffy Toons manufactures an animated rabbit with moving parts and a built-in voice box. Projected sales in units are. Each rabbit requires basic materials that Daffy purchases from a single supplier at $3.50 per rabbit. Voice boxes are purchased from another supplier at $1 each. Assembly labor cost is $2 per rabbit and variable overhead cost is 50 cents per rabbit. Fixed manufacturing overhead applicable to rabbit production is $12,000 per month. Daffy's policy is to manufacture 1.5 times the coming month's projected sales every other month starting with January, i.e., odd-numbered months, for February sales, and to manufacture 0.5 times the coming month's projected sales in alternate months, i.e., even-numbered months. This allows Daffy to allocate limited manufacturing resources to other products as needed during the even-numbered months. The unit production budget for animated rabbits for January is A. 60,000 units, B. 14,500 units, C. 45,000 units, D. 54,000 units. The answer is D. 54,000 units. The production in odd-numbered months is 1.5 times the projected sales for the following month. Therefore, the production budget for January is 1.5 times the projected sales for February or 1.5, 36,000 units, equals 54,000 units. Question 55. Which of the following would not appear in the cash disbursement section of a cash budget? A. Depreciation expense. B. Interest expense. C. Salaries and wages expenses. D. Payments to suppliers. The answer is A. Depreciation expense. Depreciation is a non-cash entry and would not appear on a cash budget. Question 56. Prudent Corporation's budget for the upcoming accounting period reveals total sales of $700,000 in April and $750,000 in May. The sales cash collection pattern is 20% of each month's sales are cash sales. 5% of a month's credit sales are uncollectible. 70% of a month's credit sales are collected in the month of sale. 25% of a month's credit sales are collected in the month following the sale. If Prudent anticipates the cash sale of a piece of old equipment in May for $25,000, May's total budgeted cash receipts would be A. $735,000, B. $560,000, C. $737,500, D. $702,500. The answer is A. $735,000. Budgeted cash receipts for May can be calculated as follows. Budgeted cash receipts, May equals amount collected from sale of equipment, plus collections from sales. The amount collected from sale of equipment is given as $25,000. Collections from sales during May are calculated as follows. Collections from sales during May equals collections from May cash sales, plus collections from May credit sales, plus collections from April sales. May cash sales equals 20% of total sales made during May. May credit sales equals 70%, portion of May sales that are made on credit. May credit sales equals 70%, 80% of May sales. Collections from April sales during May equals 25%, 80% of April sales. Budgeted cash receipts may equals $25,000 plus $0.2, $750,000 plus $0.7, $0.8, $750,000 plus $0.25, $0.8, $700,000. Budgeted cash receipts may equals $25,000 plus $150,000 plus $420,000 plus $140,000 equals $735,000. Question 57. Which of the following is the correct order of preparing operating budgets? A. Sales budget, production budget, product cost budgets, including direct materials, direct labor, and factory overhead budgets, and cost of goods sold budget. B. Production budget, product cost budget, including direct materials, direct labor, and factory overhead budgets, cost of goods sold budget, and sales budget. C. Production budget, product cost budget, including direct materials, direct labor, and factory overhead budgets, sales budget, and cost of goods sold budget. D. Sales budget, cost of goods sold budget, production budget, and product costs budgets, including direct materials, direct labor, and factory overhead budgets. The answer is A. Sales budget, production budget, product cost budgets, including direct materials, direct labor, and factory overhead budgets, and cost of goods sold budget. The sales forecast leads to the production budget, and from there the product costs budgets are prepared. After product cost budgets are complete, the firm creates a cost of goods sold budget. Question 58. The cash receipts budget includes A. Loan proceeds, B. Interest expense, C. Extinguishment of debt, D. Operating supplies. The answer is A. Loan proceeds. Loan proceeds are a cash receipt. All of the other choices are cash disbursements. Question 59. Playtime Toys estimates that it will sell 200,000 dolls during the coming year. The beginning inventory is 12,000 dolls, the target ending inventory is 15,000 dolls. Each doll requires 2 shoes which are purchased from an outside supplier. The beginning inventory of shoes is 20,000, the target ending inventory is 18,000 shoes. The number of shoes that should be purchased during the year is A. 396,000 shoes, B. 398,000 shoes, C. 402,000 shoes, D. 404,000 shoes. The answer is D. 404,000 shoes. The purchase of shoes is calculated as follows. Purchase of shoes equals production requirement plus expected ending inventory minus expected beginning inventory. Production requirement equals 2 shoes per doll, number of dolls, expected production, dolls, sales, plus expected ending finished goods inventory minus expected beginning finished goods inventory. Expected production, dolls equals 200,000 dolls plus 15,000 dolls minus 12,000 dolls equals 203,000 dolls. Therefore, the number of shoes to be purchased during the year is calculated as follows. Number of shoes to be purchased equals 2 shoes/doll, 203,000 dolls, plus 18,000 shoes minus 20,000 shoes. Number of shoes to be purchased equals 406,000 shoes plus 18,000 shoes minus 20,000 shoes equals 404,000 shoes. Question 60. Which one of the following statements regarding selling and administrative budgets is most accurate? A. Selling and administrative budgets need to be detailed so that the key assumptions can be better understood. B. Selling and administrative budgets are fixed in nature. C. Selling and administrative budgets are difficult to allocate by month and are best presented as one number for the entire year. D. Selling and administrative budgets should be a certain percentage of sales and should be developed using a bottom-up approach. The answer is A. Selling and administrative budgets need to be detailed so that the key assumptions can be better understood. Selling and administrative budgets need to be detailed in order to determine the relevant sales and administrative expense items. The relevant detail provides for more enhanced communication of goals and objectives, coordination of actions, and control of activities.